Welcome back to the channel. It's Errol with Passion to Profit. I know it's been a couple weeks, but I'm going to start this video off with a quick announcement. So if you follow me, you may have noticed last week I went live a couple times on Ticker Talker TV. And if you don't know what Ticker Talker TV is, it's their own little broadcasting channel where they host some of their veteran traders and they talk about some of their techniques, their best practices, and their overall game plans sometimes when it comes down to placing a trade. And if you did watch, you may have noticed I was on there with a veteran trader named Jeff Manson. And he's been in the industry for over 20 years trading, has a lot of experience, and there's a lot to learn from him as well. If that's something that sounds interesting to you and you would want to tune in, there will be a lot more information in the description and the links will be available down there. Now, in this video, we're going to talk about a few stocks. One's a small cap stock, one was EYEG. If you've seen it, I'm going to talk about some things on there which you want to think about when it comes down to thinking where the shorts are on the chart, where the longs are on the chart, so you kind of know where you want to set your risk levels and to where to cut losses if need be. If you can understand what the shorts are thinking on the chart and where they might be on the chart and where they may be setting their risk levels, then you can use that to profit if you're going long, and then vice versa. But I want to use EYEG as an example because it got a lot of long traders trapped into the stock and then ended up fading for the entire day. But even if you do get trapped into a stock, I want to help you recognize what type of levels should you be looking the stock to break to know, okay, this thing's done for, I shouldn't even be in this thing at all anymore. And that's exactly what I'm going to explain in this video. So now that you can see my screen, the number one question I always get asked is, what platform are you using? And the charting that you're looking at right now is called TD Ameritrade Thinkorswim. So after you sign up under TD Ameritrade, you're going to be able to download their program called Thinkorswim. And it offers a bunch of free features, more than any broker I really know out there. They have the on-demand feature, all the indicators you want. You can set up your watch list. They even have a built-in scanner you can use. And I'm going to jump to the scanner real quick because people even ask me, well, how did you even know to be looking at EYEG in the morning anyways? You can use finviz.com as a free scanner, or you can use the built-in scanner on TD Ameritrade. And if you look, I have conditions set with the last stock price, the last volume price, and the percent change. I want to look for stocks that are in play. That's why I'm looking for stocks that are gapping up at least over 20%, because those are the ones that are going to be getting people's attention. And you want the stocks where people's attention are on, because those are the ones that are moving. We the people create the volatility within the stocks. So that's something to keep in mind as well. Also, I have the volume. I want it to be trading at least 2 to 3 million volume, because it can't be too dead. I don't want any liquidity issues. It really has to be in play. I don't want some type of secret stock that is barely moving and then has a large spread from the bid and the ask and you get bad fills and all of that. That's why volume is going to be important as well. And then again, the stock price, I want to look for stocks. This should be $20, usually between $1 and $20. I'm usually only looking to go long on stocks from 1 to 10. And the only time I'm really going to be around or above $10 is usually if I'm shorting a stock. So this should really say $20, but that's just the criteria I have set. Really simple, nothing too crazy, nothing complicated. But now let's get into the actual ticker EYEG. Now, first things first, I like to start on the year chart. Let's see if we have any previous resistance levels. We can see we had this thing spiking to 1289 back in January, it looks like. So we have a little bit of movement going on back there, and then I come back down here and I'm just checking my environment to just see what was previously going on in the stock. Now let me go back. I'll just go 5 day 5 minutes, so we can just go back to yesterday on the 1 minute chart. And this is gapping up roughly, I believe it was over 100%. Let's see, closed at about 362, somewhere around there, and opened up at about 768, so roughly a 112% gap up from the night before. So you won't see these till you wake up in the morning and you're scanning for these stocks in your pre-market. Now we want to look for is this more favored for the longs or shorts? And well, I don't know. We just have to take into account what we know. We know this stock is gapping up over 100%, and you can even track statistics if you would like. How many times when a stock is gapping up over 100%, how many times is there an actual run for the rest of the day? And how many times does it go to 200, 300, 400, even 1,000%? Because it does happen, but if you track statistics, how many times is that likely to happen? And if you do track statistics, you'll notice it's not as likely for this to start breaking out and make massive runs for the day. But don't get me wrong, it still does. And a lot of these will have moves in for the longs, even in the first 30 minutes to an hour, and then it might crack and then fade for the rest of the day, and then the shorts take over. But this is for anyone just looking to trade close to market open. EYEG coming out of the gate spiked green really fast to 818, and then drops really quick, and this candle closes red, but it started off green. That's why we have this massive red wick, because it was originally green, and then because the stock price opened up right here, the top of this candle, it goes green, shoots back down below where this candle opened up at, and then closed right here, creating now a red candle with a large topping tail wick on top of it, showing us clear rejection up here. And that can let us know, okay, now maybe shorts are getting in, maybe some people were selling into that spike, taking profit, and then at the same time, shorts really trying to get a good entry and hammer this stock down because it's gapping up over 100% again. And now what we want to look for is we see this curling around, and this is what gets a lot of longs attention. It even traps a lot of longs. But one thing you want to look for is, what levels should I be looking for? So if we know shorts are getting in around this level, where do we think short sellers will get scared and maybe get out of their positions if the stock goes against them? Maybe this day high, because a lot of shorts like to risk the previous high or day highs. So if we know that, we know we can have a possible short squeeze if it breaks this day high. And we know on this bounce, if shorts are shorting this bounce, maybe they're going to short this little bounce as well to get an even better average if it's getting rejected. But you can already see the problem with that. If longs are getting in right here and shorts are getting in right here, what's going to happen right here at this moment? Nobody really knows. Nobody actually knows until it happens. But one thing you can protect yourself from is, okay, maybe I'm not going to look at this stock until it can at least break its pre-market high, or if it can at least break its day high, so you don't get sucked into this and get trapped. Okay, so that's just a little quick out the morning on the gate. And again, if you want to see that live, you can just go into the on-demand feature when you have time, go back to this day, go back to market open, and understand, if you're someone that got trapped in this, how you could have traded this better or even avoided this trade as a whole. And let's just say you do get in on these green candles right here, thinking that it's going to turn around and start uptrending for the day because it's gapping up super high. And let's say you do get in right here. If you are in, that's perfectly fine. But as a trader, when you get into a trade, you realize you maybe should not have been in, you now are in trader defensive mode. Now you're looking at, okay, where am I looking to get out if this trade goes against me? And in all reality, you should have these planned out before you even get in the trade. You should know, where am I going to get out before I even get in? Whether it's taking profits on your end or if it's going against you, where you're going to get out. And you should have this planned out before you get in the stock. But I will say, and this is just all my opinion and how I see opportunity within a chart, if I were to get in around this area and it starts to go against me, I'm likely going to have my stop loss at least at the day low, because I know if it turns around against me and it breaks the day low, it's letting me know that this trend is not in my favor. It's breaking the day low, which creates a lower low. Now we're going to have lower highs. You can see up here. Let me just get my tool so you can see exactly what I'm looking at. So if a day high is put in right here, and another high is put in right here, one thing you can notice is these are lower highs. They're lower and lower each time. And lower highs and lower lows, what does that create? A downtrend. So if you're trading, you don't want to be in anything that's a downtrend. So you can be in here, and if you bought and got trapped thinking that this was going to break the day high, you can at least have your level set right here. Okay, I know if it breaks this day low, it's probably going to have an aggressive push down. And you can see after it broke this day low, it actually had a really strong red candle breaking straight through the day low and really no aggressive bounces back up. So really no really great exit prices if you did get trapped in this in the morning. That's why it's extremely important to have your levels set to where I'm getting out right here if it breaks this level. But why? You also don't want to just have a level set for no reason. The reason in this case would be it's breaking the day low. That is showing weakness. And on the contrary, this put in the day high right here, and we would have been looking for some type of short squeeze if it broke that high. That's the same exact thing. It's just vice versa on this way. So short sellers are looking, okay, if it breaks this, I'm probably going to cover my shares, because if it breaks a high, who knows where it can go? It could go to $9, $10, $11. And depending on how powerful the short squeeze is and how long the short sellers want to hold and not get out of their positions, it'll squeeze the stock even higher. So sometimes it's in most people's best interest to maybe just wait for the day high to be put in, wait for the day low to be put in, and then make a decision. Also, if you are a long that got in right here And that's perfectly fine. You just want to make sure you have your risk levels set. If you are someone that got in right here, that's another reason why I don't recommend people going in with their full position size off of their first entry. It may be a lot smarter for you to maybe scale into your position. So you can add, let's just say you had one share right here and it breaks the pre-market high, you want to add another share or whatever share count you usually trade with. But never going in off the first entry with your entire never your entire account, but your entire position size. You never want to go in full right off of the bat. But again, that's just the simple thing I wanted to show for this video. And I wanted to let you guys know, sometimes just wait for the day high to be put in, wait for the day low to be put in, and then now you know the levels that the shorts are going to be risking off of, and now you know the levels that the longs are going to be risking off of. And you can use that to your advantage. And even if a trade goes against you, you can minimize your risk and just manage your risk overall if you know the correct spots to come out, knowing, okay, this is probably done for, it's not going to come back. If we saw this come down right here and consolidate on this day low for a while and then maybe perk up and start uptrending, creating some type of double bottom, then that's going to create a factor where the short sellers are going to be kind of scared. They're going to see a double bottom forming. They're going to see that, wow, this day low is not breaking, it's holding up. And that's going to make them emotional. And then that's where they're going to want to cut their losses. And when shorts cut their losses, it creates a lot of buying pressure to the stock. So that's one thing to think about. Understanding where the shorts are on the chart, understanding where they may be risking, understanding where the longs are in the chart, and understanding where the longs may be risking. Because again, if you're a short seller and you short this spike, you're going to be happy when you see this day low breaks. And if you're a long and you bought in right here, you're going to know, okay, maybe this trend isn't my way. And as you can see, it faded all day after that. So that's pretty much it for this video. I just wanted to show that little concept that I think can help so many traders out. Don't be forced to jump in on a first green candle or even the second green candle. You can just wait 5 to 10 minutes after market open to make a decision. Think about it. I want you to look back at some of your trades where you're trading right when the market opened and see if there will be a big difference if you would have just waited maybe 5, 10, 15 minutes after the market opened for the stock to really choose a direction. And then would your decision have been different if you would have waited? Sorry, I could barely get that out. But that's just a little food for thought when it comes down to trading. I just wanted to throw that out there to kind of get you really thinking, because I realize one of the best ways to learn in the market is to just really kind of see how other people think, kind of hands-on with you trading, and then you kind of just get light bulbs here and there, and then you kind of put the pieces to the puzzle together over time. But that really comes with screen time, and there's just no shortcut. There's no secret formula. There's none of that. It's just a lot of experience, more screen time, and that's about it. There's just no cheating anything in life. So you're just going to have to put in the work, put in the time, and you'll start recognizing a lot of these moves a lot sooner, and you will be able to protect yourself seeing some of the stuff like this, because I know a lot of beginners still get trapped into things like this, and that's, again, that's fine. But the part which you don't want to do is hold on to this entire flush. You don't want to do that all the way from $8 and losing about $3 per share. That's something you don't want to know. You want to cut losses very smart and just know the key levels that are going to be more important to cut losses on, and knowing, okay, this stock is probably not going to come back. One thing I'm actually going to add real quick before we end this video is the VWAP. This may help a lot of beginners. Just going to add the VWAP and I'm going to apply it. And usually I like to take off this top band and lower band, but it might even help some traders as well. But one thing you can look at is if a stock is trending above the VWAP, actually making higher highs and higher lows above the VWAP, that's showing strength. If the chart is making lower lows and lower highs beneath the VWAP, that's showing a lot of weakness. And again, just because I see a lot more people trying to buy beneath this, in which it's just not likely in your case for it to actually reverse and turn around, when you can just wait for it to cross the VWAP and have much better success over the long term trading above VWAP than below VWAP. Because again, we know above VWAP is strength, below VWAP is weakness. Just some more food for thought. That's going to be it for the technical analysis for today. So I hope you enjoyed that video and learned something new. One thing I forgot to mention in the beginning of the video about the Ticker Talker and going live on there is I actually won't be on there again until after New Year's, just because we have Christmas coming up, then the New Year, all that good stuff. But we're going to go right into it after the New Year again. But right now you can still log on there and watch some of the older traders on there talk about their processes and just learn something new. Thanks for watching the video. I appreciate your time, and I'll catch you guys in the next one.